the show. Hi Matt, good to be speaking with you. And firstly, lots of commentary with respect to tariff announcements and those which are likely, because 1st August deadline is just a couple of days away, and President Trump is saying that he's thinking of putting a 15 to 20% tariff across the nations, which still haven't come out with a trade deal yet. Give us your sense that where is the trade deal headed? Can we be in to see more trade deal announcements, and more so, how are the markets going to react to that? Because for now, the US markets are seen to be climbing that wall of worry, if you say.
Yeah, good morning. It's always great to join. And I've been constructive on the outlook for the markets, particularly US equities. And I think the trade deals that we're seeing get signed, and at least where the tariff band is starting to narrow to, are all marginal positives, not only just for the US economy, but for the global economy broadly speaking. If you think all the way back to April 2nd on Liberation Day, we were thinking and penciling in tariff rates of probably 50+% for a lot of different countries across the global economy. And so the fact that we're starting to settle in this 15 to 20%, it is generally manageable, and at least the company management teams that I speak to here in the US and those across the rest of the world too, that's a band that they can work with, they can help manage around. It doesn't mean there might not be challenges that are felt more by certain industries than others, but broadly speaking, we can at least have some certainty with respect to where things are going. So it removes, I think, the worst left tail scenarios from the table and allows us as investors to really focus on what matters, which are company-specific fundamentals and where earnings are actually taking us. And what we're seeing, at least in the US right now, and the reason why I think the US has really started to outperform other global markets very recently is because second quarter earnings have been so strong. Companies are reporting very strong earnings, and not only that, they're reporting very good margin numbers, which shows that the tariffs that have been implemented to date really haven't had that significant of an impact on their bottom lines right now. So I think that's why there's so much optimism. That's why I remain optimistic, and I continue to encourage clients to use downside opportunistically to make sure their portfolios are well balanced and leaning into where some of those durable secular growth themes are going.
Matt, I think the bigger concern, hi morning firstly, for India at least, is the fact that you've got an oil uptick of about 2%. Trump's shorter deadline for Russia clearly not working out, and it's bearing heavy on oil. Where do you think the oil markets are going to find their feet?
So, Aisha, I think oil markets are pretty much range-bound at this point, barring any sort of escalation in geopolitical conflict. We saw what that could look like very briefly, thankfully, during the showdown with Iran. But oil markets generally settled back into where supply and demand should have them. So I wouldn't think that we're going to see sustained oil prices probably above $75 to $78 a barrel unless we start to see more increased geopolitical conflict. So I think that's a good thing, generally speaking, for emerging markets. Where we are right now, as you pointed out earlier in the program, I think is very manageable for an economy like India. The key is going to be, how does India proceed with negotiations with the US and tariff deals, and the read-through from Trump with respect to what's happening with Russia, and can India maybe use a trade deal to increase its buying power of U.S. oil as potentially a replacement for Russian oil? I think all of those scenarios are still in play right now.
Matt, hi, good morning. There are a lot of cues to watch out for as far as the Wall Street is concerned. A, the earnings trajectory, B, the tariff scenarios, and C, the important FOMC meet and the interest rate decisions which will come out for. Now, the commentary is also something which is important, and most of us are expecting the rates to be held steady. What's your take? Is it the next trigger which will help the markets in there?
So I also expect that rates are going to be held steady. That's pretty much the 100% consensus view at this point. And as you pointed out, it's really going to rest on how hawkish is Powell during his commentary. And I expect Powell is probably going to try his hardest to say absolutely nothing new and try not to feed into any of the questions that we know are going to come with respect to, is he going to step down? Is Trump going to replace him with someone else? I think that's a lot of fodder for noise and speculation in the market. But at the end of the day, while Powell is the head of the Federal Reserve, there's a voting member committee. And right now, at least, you maybe have up to 2 dissents at the maximum from this meeting. And so policy still on pace. I don't expect we're going to see rate cuts at least until we get into September. And at least the data right now, with the U.S. economy holding up so well, and the fact that inflation's pretty much steady, we also don't know how much tariffs might eventually feed through. There's just no reason to really need to prematurely cut interest rates. So my base case expectation is still that we're going to see 1 to 2 rate cuts this year, and certainly they're not going to kick off until at least September, likely into later in the year, November or December.
All right, and lastly, Matt, help us with your take on the dollar index as well, because there too we have seen a bit of a jump up from that close to 96 odd mark. It's once again inching higher, and 98.4 is the latest print. That generally doesn't bode well for the emerging markets. Help us with your take. Do you believe some bit of a jump up over there, or that continues to be range bound?
So I think the long-term trajectory for the dollar is still going to be lower. I think that the pop that we've seen is more technically driven. It's driven by a little bit of profit taking, especially after big losses earlier in the year, really for the whole first half of this year. And so I think that downtrend is going to resume. And that's one of the reasons why I'm still very optimistic on the emerging market complex, especially as a diversifier for portfolios that might be too heavily tilted towards the US right now. So I would be using downside to buy into high quality companies across emerging markets. India is certainly one of those countries that I think presents a lot of opportunities. When you see some of the FII selling, I think that's a little bit short-sighted, probably driven more by dynamics with the strength that we're seeing in China. But long-term numbers in India still look strong, and a lot of the high-quality companies I like in the bank part of the market, certain automakers in the market, and those who are leaning into more artificial intelligence into their business, their earnings results have been really, really strong so far. So I think there's a lot to like, and I have been using downside in very specific names right now to set myself up for when we do see a resumption in the macro favorability towards emerging markets in India in particular.
Okay, that was quite an insightful conversation. It was a pleasure talking to you, Matt. Thank you so much for giving your time to ET Now. We expect such conversations moving ahead as well. Thank you.
Thank you.
Let us now move to the technical front of the market. And if you see, it was quite a challenging day session and a start of the week for the